everyone. We are just waiting for people to come into the meeting, but we will kick off on time. It's great to be here this morning. Our webinar today is all you need to know about the latest developments in transfer pricing and corporate and wider tax in the Dutch Caribbean region. So we're very, very excited to be here today. There's so much happening in the tax space in the last few years. And I'm particularly happy to be chatting with Vivian and Taxxa around this very exciting region of the Dutch Caribbean. So now it gets more exciting. So just a little introduction to myself. I'm Cabrini McCarrick. I'm the transfer pricing partner at Regan Van Rooy. Regan Van Rooy is a boutique tax and international tax firm, and we focus on transfer pricing across the globe. And one of our passion places to work is with Vivian in the Dutch Caribbean region. We've got offices in Europe, in Africa, and we kind of cover all sorts of things on transfer pricing across the globe. And as I mentioned, really happy to have Vivian Pieters here with us today from Taxxa. We have worked together back since, I think, our old Deloitte days across various parts of the world and various corners. And we've been partnering in this region around transfer pricing and wider issues. So super excited to have Vivian here. And Vivian, I'm just going to let you introduce yourself, say good morning, and tell a little bit about Taxxa.
Yes, thank you, Cabrini. Good morning. I'm Vivian Pieters. I'm a tax partner at Taxxa. There I advise businesses across Aruba, Curaçao, Sint Maarten, Bonaire, Statia, and Saba. I've been working in tax for over 19 years now. And throughout that time, I've had the opportunity to work both within the Big Four, so at KPMG and Deloitte in the Dutch Caribbean, and in advisory roles closer to business operations. My background covers tax accounting, tax assurance, tax risk management, and international tax advisory. So I've seen transfer pricing not just from a compliance perspective, but also from the financial reporting and risk side. Over the years, I've worked with multinational groups, and one thing I've consistently noticed is that transfer pricing becomes problematic when it's treated as a last-minute compliance exercise. So my approach is slightly different. I look at transfer pricing as a strategic tool. It needs to reflect how the business actually operates. It needs to be defensible from a regulatory standpoint, and it needs to make commercial sense. Ultimately, transfer pricing should support profitability and long-term value creation, not create unnecessary risk or complexity. And that's the perspective I will bring into today's discussion.
Perfect. Thanks, Vivian. So we've got a lot to talk about today and a brief look at our agenda. So for a lot of people within the region there, transfer pricing is relatively new. It is a kind of a new thing. And in a lot of regions globally, it has become not so much new, it has been there, but what's happened is it has been heavily legislated and been driven from a global perspective. So that's why transfer pricing, you will hear more and more about it. But we're going to talk about what it is, how it's going to impact your business, what's happening globally, and then we're going to drill specifically into the Dutch Caribbean region. And of course, Vivian is going to bring all the local knowledge that she has there and how to think about transfer pricing. The aim of this is to help you understand how transfer pricing might impact your business and what are the kind of simple next steps to take going forward. So what is transfer pricing? This is a big question, okay? So it all started with the fact that as a global community, business started internationalizing. So we, instead of having one entity operating something, we might have multiple entities or two entities in different regions. And now all of a sudden, the tax authorities care about that because you're looking at how are you sharing profits between different regions and therefore what tax you're paying in that country. So it became a really controversial topic over the last number of years because a lot of jurisdictions felt there was a lack of transparency around tax and there was a lack of transparency around tax between groups. How do they pay tax in different jurisdictions? And is every tax authority getting their fair piece of the pie? So this kind of came off a project you will probably be familiar with, which is the Base Erosion and Profit Shifting Project. And transfer pricing is ultimately driven at an OECD global level. And off of all of that work that's been happening to basically bring the tax landscape into the modern world, into the digital world, to kind of really fix some global structural problems with tax, they have really started to enforce this thing called transfer pricing. So there's a political kind of spear to it. And also the world is looking for tax transparency. Maybe 20 years ago, you went to your advisor and it would be very much about how to pay the lowest tax where on paper. But transfer pricing and the principles around the Base Erosion and Profit Shifting Project has really shifted the narrative. It has shifted leadership's perspective, CFO's perspective, and tax authorities' perspective to what they call kind of fair and transparent practices. So transfer pricing is really the bedstone of tax if you have more than one entity within your group, right? It essentially looks at how you distribute profits and where you pay tax in different countries. The issue with it is that the nature of transfer pricing is normally cross-border transactions. So you have your local tax authority to keep happy, but you also have to have the other tax authority. It's a tug of war between different jurisdictions. So there's quite a little bit to manage when it comes to transfer pricing. The key focus on transfer pricing is, as we mentioned, it's cross-border transactions between connected persons. And we will drill into that later on. What are these transactions? What do I need to be looking out for? And who are connected persons? But from a simple perspective, you will kind of know yourself if you've got more than one entity within your group and they're in two different jurisdictions, you need to start thinking transfer pricing straight away. And you need to start identifying what potential transactions exist and what potential compliance or strategic opportunities that you might have when looking at these matters. So transfer pricing is all based on this one principle called the arm's length principle, right? Every single country follows the same principle, OECD. And essentially what it means is how we transact with our related party should be the same as we transact with a third party. So we cannot have favorable or prices being sold into different jurisdictions. Why? Because that would lower the tax that I pay in the other jurisdiction. We cannot not charge for stuff, which is really common in jurisdictions that transfer pricing is new. We say, oh, we're in the group. It's, my good friend over there. And we treat them like family or within a group, or we look at something from a group rule perspective. Transfer pricing is actually kind of separating that into distinct legal entities and distinct tax jurisdictions and saying, you now need to pay an arm's length amount. You don't just need to do that, you need to prove it, you need to pay for it, you need to document it in a very specified and legislated way. But the principle in itself is simple, but you do need to do quite a bit of work around getting to the right answer. So in general, the onus is on the taxpayer, right, to comply with this principle. The onus is on the taxpayer. And there's in different jurisdictions, sometimes that burden of proof changes. But as a general principle, it's up to the taxpayer to make sure that their transfer pricing is in order. And we do this through various types of documentation that we will be going into. You'll have heard of the local file. You might have heard of the master file. You might have heard of country by country. And it might sound like gobbledygook, or it might be something you already have in practice in your business, but they're very specified documents. They follow a very rigorous format. And that is now what is required in light of the new space of legislation that we have within your region. So what it focuses on really is who is doing what in what country. If I am a manufacturer in one country and I am selling to a related party in another country within my group and they're a distributor, who is doing what, who is adding value to the value chain, and therefore what price should occur for those transactions. And it's essentially about who is getting paid what and what profit is going to end up where. So when you think of your business, it's pretty fundamental to your business model. If you have, again, we're assuming you've got related parties and you're within a group and you have other entities, then transfer pricing is very integral to your business. Whether or not you're complying with the legislation or not, there will be flows happening between entities. There will be different types of things happening, and that's where transfer pricing comes to rear its head. So there's a lot of forces that impact transfer pricing. So the first is we have new legislation in the countries, and this isn't just within your region. In Africa, we've had 12 countries with new and updated legislation in the last 3 years. Ireland has recently come on with the minimum tax rates, new legislation. Cyprus, loads of European countries, including the UK, have updated their transfer pricing legislation. The US is always doing a little bit of something, but they've had transfer pricing legislation for a long time. But because of this focus on how groups deal with each other and whether or not that erodes the tax base in certain countries, it's become top of agenda. So what have they got? They've an increased focus on tax transparency. Tax is no longer something you just know yourself or you keep hidden. With these documents that are being prepared that you have to provide to tax authorities, it is so much information about your group. What do you do? What's your intangible strategy? What are your transactions? What's your head count? The information is quite intense, and now this information information that you might not before have had a reason to show your tax authority is becoming looked at. In the rest of the world, there's information sharing between tax authorities. Vivian might touch on later the specific rules in that country, but basically if one tax authority is auditing, they can request from another tax authority information. So there's this whole new flow of information happening around the world that obviously means we need to take transfer pricing serious, we need to understand it, and we need to manage it in terms of its compliance. Okay, so the other question is, who cares about transfer pricing? So first of all, obviously the tax authorities care. How do we know they care? The tax authorities and the governments and the regulatory bodies, because they're have legislation, they're building up their skills to be able to deal with transfer pricing. We're in early days in certain of your jurisdictions, but obviously those who are involved in the Netherlands side of it have long-standing transfer pricing rules in place. So the tax authorities care and the regulatory bodies, if you're kind of in the financial services, you're highly regulated, it's absolutely critical to have your ducks in a row when it comes to these compliance obligations. Obviously, you as the taxpayer are going to care, but not just because now you might have to do extra stuff, but you have to manage extra risk. And because it can impact fundamentally where and how you pay tax, the C-suite cares, because they care at the end of the day, what money is going to be coming out of this, what's my tax exposure, what's my effective tax rate. So everybody, it's not just a tax function, it's a business function. So the people that we're often talking to about transfer pricing isn't just tax, it's the business people, it's the leaders within the business. When you can manage to get their attention for long enough before they're, inventing a new entrepreneurial idea, they care about it because it impacts the fundamental financial flows within the business. Your stakeholders care because if you have seen the global press around transfer pricing has been, there's a kind of almost a moralistic tone about it. You know, are you evading tax? Are you doing something wrong? This isn't allowed. It's all over Instagram. You know, we have massive cases with Google, with Coke, with Pepsi, with the mining players in the financial industry. You don't want your name as a business to be attached to eroding the tax base of a country, because that's what it's about. They're saying if you don't do your transfer pricing right, you are not paying the right amount of tax. And not just that, you're potentially eroding another country's tax base. So that's where it gets a little bit political, a little bit messy, and not a situation that you want to be dealing with. So it is important that we do understand that and manage any, reputational consequences about that. Normally, they look at low versus high tax jurisdictions, right? So what's the biggest risk in transfer pricing is if I have a high tax jurisdiction and a low tax jurisdiction, and I don't do my transfer pricing correctly, such that I may have excess profits sitting in a lower tax jurisdiction, so the high tax jurisdiction wants its piece of a pie. So there's lots of things to think about, but it's all about how do we operate as a group and how and where do we pay tax, and if it's appropriately supportable under all of the new legislative requirements. Now, the good news is that yes, it's about compliance, and yes, it's about understanding our risk, but there's also a lot of business model optimization into this. If we structure our businesses appropriately, if we understand what transfer pricing is and what is required to substantiate such business models. So a lot to think about there. Let's talk about the type of transactions that typically happen between group entities and are typically governed by transfer pricing. It is basically any transactions between two connected persons within a group, okay? That's services. So let's say I have a shared services center and I've got my group CFO, my group CEO, and my group strategic leader over here. There might be services. We normally call them management services, right? So there might be management services being provided between one entity and the other entity. Now, first of all, we have to recharge for those. Second of all, we're supposed to put a markup on those costs to comply with transfer pricing principles. It's not just recharging, it's recharging at an arm's length basis, which means if I wasn't connected, would I do it at cost? The answer is no. If I was providing this for a third party, I'm going to do it at cost plus a margin. What's my margin? That's the arm's length nature of it. But it's any type of services between entities. We need to try and identify them, understand them, document them, and recharge where appropriate, and recharge an arm's length amount. The other type of transaction is goods. Any type of goods. If you're buying or selling, doing anything with goods, doing a procurement function, one entity for another entity, you're looking at your goods flow. Anything with goods tends to be high value, high risk, right? Because the tax authority is always most interested in highest value transactions, and goods can obviously sometimes be more than services. The other type of transactions are loans. So very common is, is the quantum of the loan arm's length, and is the interest rate of the loan arm's length? Are you paying interest? Are you not paying interest? Is it arm's length? We often see in situations where we have a lot of interest-free loans flowing about, right? And a tax authority who's scrutinizing your transfer pricing is going to say, well, who else is going to give you an interest-free loan? We want our interest, it's revenue, and then if it's not arm's length, it's not deductible. So all of these charges link to, if it's not arm's length, does that impact my deductibility, and does it impact my ultimate profit line at the end? So that's on loans. And the other type of transaction, which is more complex, is intellectual property. Does the group own intellectual property? Does anybody else use that intellectual property? Should there be a charge for that intellectual property? Intellectual property is a complex area because it can be something like the right to distribute to a brand or a reputation to a product intellectual property, to a software, to a system. Sometimes even to identify that for groups can be tricky, but one needs to identify it and determine how to deal with it from a transfer pricing perspective. So what are tax authorities looking for now? The first thing that you will, sorry, there's a bit of a sound coming back, Vivian. If you maybe could go on mute for a moment, I think there's a reverb. Thanks. So the tax authorities their starting point is to look at, do you have transactions and do you have any transfer pricing support for those transactions? And if you don't have any transfer pricing support, that's when they start challenging you and asking more questions, and you have to figure out your transfer pricing pretty much on the run. The other type of thing that a tax authority is looking for is, where does your significant people functions happen? So if I'm generating all my profit in one entity and I'm making all my money here, and I've got loss-making entities elsewhere, or break-even entities, or ones that are earning less profits, what the tax authority is looking at, who are the significant people in the business? Because profit in the value chain is typically attributed to the significant people functions and activities and risks. So, this is why it's not just a normal tax that you might be used to. We actually have to look at the functions of the business, the assets of the business, the risks of the business, and who controls and manages those items in terms of the significant people function. The tax authority loves looking at loss-making entities that have been loss-making entities for too long, particularly if there's another entity within the group that makes profit, because they want their piece of tax. They want to know, why is this entity loss-making for so long? Is there a transfer pricing issue? High value transactions, as we mentioned, that's obviously where a tax authority wants to look at. If the transaction is $2,000, probably they're not going to waste their time auditing you on it. So always, like anything else in the world, if it's high value, you can expect a greater deal of scrutiny. The other type of transaction that's often analysed is if my core business is related party. So that means if the bulk of my revenue or the bulk of my costs is as a result of business that I do with a connected person, I am a prime target for being looked at. If 99.9% of what I do is total third party, I've less likelihood to be looked at. I'll still need to be compliant. I'll still need to do what I need to do, but it's the same with the value of the transaction. So it's understanding your entity's position in the value chain to figure out, how important transfer pricing is to your particular business and what you need to do about it. This is a brief look at what we call the transfer pricing lifecycle. So the first thing is the policy design and planning, which a lot of businesses are at now in countries where they've had to deal with transfer pricing for the first time. This is basically identify the transactions and figure out, what are the basic things I need to do? Do I need to mark this cost up? Is this a legitimate charge? Do I need a legal agreement for this? What are the flows? Is my loan fine? Do I need to charge interest? What are the flows? And creating a plan for that. After that, you have to get to this thing called documentation and benchmarks. And that is these new rules that we have in a number of the jurisdictions within your region that make it mandatory to prepare certain documentation known as the local files, master files, and country by country. The good news is there's some exemptions and thresholds to them. So it obviously, the obligation is much more significant when you're reaching those thresholds, but you do still have to comply with the law and the rule, but you will have a more simplified approach to supporting your transfer pricing. So that's a key distinction, is understanding how big is your burden? Do you meet the thresholds? If not, what is it you're required to do? But this is annual. Transfer pricing, like other taxes, it's an annual event. You have to have certain documentation, benchmarking studies to support your pricing. People often get a big shock the first time they see a local file. It is a hefty document. It might be 100 times longer than your tax return. It's got a lot of stuff in there. The aim of doing all of this is so that you avoid the dispute resolution, right? You avoid upsetting your tax authorities and spending a lot of time on a dispute. Transfer pricing globally is the biggest area of dispute. We have the highest value of transfer pricing adjustments than any other tax globally over the last 5 years. It is where the tax authorities are focused. Different jurisdictions, of course, will vary, but it is really, really critical that the tax authorities themselves think there is money for them to be gotten in analyzing their transfer pricing. So that's why the enforcement and the compliance has increased so heavily across the globe. A little bit on the global trends. So transfer pricing, obviously, and we have Pillar 2 and global minimum tax, right? They're all interlinked. It's about transfer pricing, tax fairness, not being hidden by the corporate veil. I mean, there's been so much talk about this, but there's lots of wider activities going on that are heavily interlinked. Pillar 2, for example, is all about transfer pricing principles and marketing returns and digital taxes. We've so much to think about. But on the wider platform, there is a lot happening in this space. Tax transparency, general rise in tax audits, and a lot of scrutiny around intellectual property. There has been a global kind of reduction in the use of tax havens, or the kind of business model restructures to basically have a optimal business model, but within this new framework that has been developed off the back of the OECD over the last 10 years. So, for example, a stronger substance and anti-avoidance rule, but the focus of all of this is around substance over legal form, right? Do I have a legal post box that does nothing, earning a lot of money in a jurisdiction? Or what is the substance, the economic substance of that arrangement? Does it legitimately attract profits? So the whole world is kind of, I don't want to say it's all they're focusing on, but in the tax space, it's never been more things happening than all these global rules. The world kind of has demanded tax transparency. They've asked for better compliance. And as usual, the corporates are left suffering the burden of that in terms of, now I have more stuff to do. I thought my job was hard enough, but we've got a lot of other stuff to do. But okay, we'll try and find some good, positive news in all of this soon. But it's a lot to take in, and there's a lot happening. A little brief overview of the Dutch Caribbean region. So this isn't spanking new. Back in 2018, we started to talk about country by country, Aruba and Curacao leading the way in terms of they have a legislation that you have to have a massive file, you have to have a local file. If you meet thresholds, you have to do country by country. And the Caribbean Netherlands, there's a new tax plan proposed in 26. They generally follow the OECD principles, and the Netherlands has had legislation for a long time, and the OECD is obviously the bedrock of transfer pricing. But the big change really has been specifically requiring local file, master files, and country for the last few years. And what does that really mean? So I think just looking at Aruba, right, we've got some super high thresholds when it comes to country by country, and we're going to break down what are these things. What is country by country? Country by country is basically a load of consolidated group financial information and some factual information that needs to be submitted to a tax authority at an ultimate parent level. Now, only certain groups meet that. If you meet it, you got to consider it. It's something that you have to do annually, and it is complex the first time you do it. But it's basically a financial data, and whilst it's not supposed to be used for auditing you specifically, obviously it gives a whole lot of information to a tax authority about a group that they've never been privy to before. So one needs to prepare yourself for that. The master file and the local file are two different things, right? The master file is a high-level document which describes what your group is, what is the financial strategy of your group, what are the financial transactions within your group, a high-level overview of your transfer pricing policies, and quite a bit of detail around your intangible strategy. It's meant as a group snapshot of how your business works, right? The local file, on the other hand, this is where your detailed technical analysis goes, right? This is where you have two main things. One is called the functional asset and risk analysis, and the other is called a benchmarking study. And basically, the functional asset and risk analysis is done per transaction, and it says who does what where, what assets are employed in doing that, and what risks are borne by either parties. So one needs to understand that to determine what's the appropriate remuneration for those transactions. We then go to the benchmarking studies, and I won't get into the detail of that, but it's basically there's global databases used by the tax authorities, accepted by the OECD, that at some point we assume will be adopted in your jurisdiction, where you get independent company data and you use this in a very specific format to support your transfer pricing principles. So if you haven't seen transfer pricing before and you haven't seen a transfer pricing report before, the main thing to know is that there's quite a bit to do to create these local files, to create compliance, to understand and document your business in that way. And until that work is done, it's hard to manage your risks, right? Because you don't know yet, you have to do that work and you've got to get compliance and then you've got to manage your risks. But okay, from an Aruba perspective, master and local file, if group consolidated revenue is more than 100 million, that's not gigantic. You meet it or you don't meet it when it comes to these things. Most groups may not be responsible for country by country reporting at this stage, but most entities will likely require a local file. The important thing to note about what happens if we don't do it, we have penalties, we have potential tax exposures, and we have potential reputational consequences, and we're not compliant with the law, which can hold up our audit process and regulations. So quite a little bit of consequences around it. You know, you basically always want to be able to, when the tax authority asks you for something, say, yes, of course I'm compliant, of course I have it, and here is my beautiful file. Doesn't always happen that way, and when new legislation comes in, it often takes quite a bit of time. So understanding the level. If you're meeting these thresholds, this is mandatory. It's got to be done annually. It's got to be prepared on time. It's got to contain a lot of information. If we are below those thresholds, we still have what's called a simplified local file obligation, which is we still have to comply with the arm's length principles and support our intergroup transactions. We still have to comply with it. It just means we don't have to do as much work in our documentation, but as a taxpayer, we still have to comply with the rules, which is to transact at an arm's length basis and to be able to evidence that when it comes to call. We've gone through a little bit of this already, and I kind of covered it on the last slide, right? The local file, the master file, and the different thresholds. So, I mean, I always say if you're dealing with transfer pricing for the first time, it's just key to understand, am I in a group? Is there more than one entity? Are they in different jurisdictions? And do we have transactions, right? In some cases, there'll be a question about, are we connected or not? And the definition for connected parties is quite wide. And normally a good starting point is, understanding from your financials, the percentage of ownerships, management and control. The OECD definition is quite wide, but normally groups will know if they've got connected parties in different jurisdictions. And then you've got to drill down on what you need to do next. It is annual. Your local files and master files are due when you're filing of your tax returns. In most cases, it is available upon request. So that means it's an exercise that you have to have done within a certain time, but you may not have to submit it immediately. But what happens, and Vivian will have more insight on this in countries, is that in your tax return, you will normally have a list of transfer pricing questions that says, have you done a local file? Did you meet the thresholds? You know, you've got a whole load of questions you have to add. I can't be sure, and Vivian, you can touch on this later. Have they made those changes yet locally? Because normally that'll be what'll happen is that your tax return will be used to kind of, you know, for you to answer transfer pricing specific questions. I think I'm not going to go much more into this detail, Vivian. I want to make sure we've ample time to get through everything, but this is a snapshot of all the types of information that are going into these beautiful files: business overview, intergroup transactions, local management, functional analysis, benchmark, selection of an appropriate transfer pricing method, your financial and tax positions, your intangibles, your group operations. Imagine it as the book that you're writing about your company that you never knew you had to write, and you certainly never knew you had to share it with anybody before, let alone a tax authority. It's something quite different than any other type of tax or any other type of simple information that you used to have to give to a tax authority. So quite a lot happening in that space. We will be circulating these slides afterwards, right, to everybody. So because I know I've gone through this information quite quickly. It's just a 1 hour block to give us an introduction into transfer pricing. But we have here, like, what is a connected party in different jurisdictions, right? More than 25% ownership or control. You will know this better than I know it in these jurisdictions, but understanding who's connected. What's important is how sometimes we may not be aware of where we're connected. You know, we're not aware that we're connected, and we need to start thinking about that. And you will generally know yourself, but we need to start applying those definitions to see, do I have related party transactions, and what do I need to do about it? We talked a bit about the why. Why do we do this? Why? Because it's legislated, because it's a matter of compliance. Because if we don't, we can have tax adjustments, which have income, which have penalties. So with transfer pricing adjustments, you can have an adjustments to the profit. You can often suffer double tax, right? Where we have to make an adjustment on one side of the equation, but we're not making it on the other side of the equation. It's very complicated. And just penalties for non-compliance. But worse than non-compliance is if I have an exposure, what's the penalties that then can be applied? So that normally happens to a dispute and audit process. And at this stage within your region, unless Vivian can tell me differently, we're still early on in any type of, we're starting, they're asking, the tax authorities, we've dealt with the number, they're asking for stuff, they're focusing on stuff, but we haven't had like a full-blown court case, as far as I know, Vivian. You know, we haven't got to the stage that a lot of the other jurisdictions in the world have gotten to. So that means it's a good time now to understand, do you have an obligation? What is that obligation? So that you can save yourself from some of the pitfalls that honestly the rest of the world have been dealing with, where they've been dealing with transfer pricing for many years. So I think in terms of that, it's good timing. Now, I have said a lot, Vivian. I want to hand over to you. Over to you.
Thank you. Thank you, Cabrini. Go to the next slide, please.
Sure.
Next slide. Yes, thank you. Let's start with why this topic is becoming increasingly important in our region, so in the Dutch Caribbean. Over the past years, we have seen a very clear shift. Tax authorities across the Dutch Caribbean have significantly increased their focus on transfer pricing. This is no longer theoretical. We are seeing real audits, so real tax audits, real challenges, and real adjustments. The OECD transfer pricing guidelines are now being applied much more strictly in practice. So in situations where certain intergroup services were previously accepted without a market, for example, authorities are now expecting at least a 5% markup as a minimum standard. That may sound small, but in larger groups, those adjustments can quickly become material. And importantly, the impact is not limited to profit tax. We are also seeing consequences for indirect taxes, which many businesses initially overlook. So the message is actually very clear, Cabrini. Transfer pricing in the Dutch Caribbean is no longer something you can treat lightly. Given the potential for substantial adjustments and penalty, businesses really need to ensure that their transfer pricing is properly implemented, not just documented. Go to the next slide, please. Next slide. Yeah, profit tax. Let's start with the profit tax rate. As you can see in this overview, the profit tax rate varies significantly between jurisdictions. St. Martin has a general rate of 34.5%, which is high. Curaçao applies a two-tier system, 15% on profits up to 500,000 guilders and 22% above that threshold. Aruba applies a 22% rate. And in the BAS, in the Caribbean Netherlands, so Bonaire, Statia, and Saba, there is in principle no profit tax. Although a minimum tax regime may apply, but that's another regime. I would like to elaborate more on the tax system in the Caribbean Netherlands. That's the BAS Islands. The BAS Islands do not have a traditional tax system. A company is in principle deemed to be established in the Netherlands. However, the company may submit a request to the BAS tax authorities to be treated as established in the Caribbean Netherlands, in the BAS Island. If this request is approved and all applicable conditions are met, the company will be considered established in the BAS. If the company is regarded as established in the European part of the Netherlands, so the Netherlands itself, Dutch corporate income tax and dividend withholding tax will apply. Conversely, if the tax inspector approves the request for BAS treatment, the company will fall under the BAS tax regime. And under this regime, there is no profit tax. So let's assume that in this case, the company is established in the BAS for tax purposes. You can see the differences in the tax rate, with St. Martin having 34.5% and the BAS Islands no profit tax at all. These differences create natural incentive for multinational groups to allocate profit across jurisdictions. And that is exactly why tax authorities in the Dutch Caribbean are paying close attention to intercompany pricing. So when you have no profit tax at all, one side, and 34.5% environment on the other side, even relatively small pricing adjustments can shift significant amount of taxable profit. From a tax authority's perspective, that is a risk. From a business perspective, that is exposure, if not properly structured and documented. Go to the next slide, please. Yeah, so when we talk about transfer pricing in practice, a key question becomes, how do we allocate cost and income within a group in a way that reflects economic reality? This is where allocation keys become important. Depending on the nature of the service or activity, different keys may be appropriate. For example, turnover can be relevant when services benefit entities in proportion to revenue generation. Time spent, whether actual or estimated, is often appropriate for management or support services. The number of employees may be used for HR-related services. Labor costs or time spent may be relevant for operational support, and for IT services, the number of users can be defensible allocation basis. The key principle is that the allocation must reflect the actual benefit received and the underlying functions performed. As noted on the previous slide, the highest profit tax rate applies in St. Martin, whereas no profit tax is levied in the BAS Island. So accordingly, where supported by the transfer pricing regulations, the company may apply an allocation key that is more tax efficient for the group. For example, the one that allocates a greater portion of expenses to Sint Maarten, in this case, and a smaller portion to the Best Islands, provided that the appropriate allocation methodologies is used. Or if you look at the income side, greater portion of income to the Best Island because there is no profit tax, and the smaller portion of the income to Sint Maarten. Next slide, please. Yes. During recent tax audits, the tax authorities have increasingly focused on these two transactions, the intragroup support services and the external services. Next slide. Let's start with the intragroup support services. These are services such as finance support, HR, IT, administrators functions, so activities that are provided within a group but do not typically involve risk. So these are low risk activities. For these low risk activities, a cost plus methodology is generally applied, what Cabrini just mentioned. A profit markup of at least 5% is widely considered an appropriate starting point. In practice, this means that simply recharging costs without a markup is no longer acceptable in most cases. And if you look previously, no markup was accepted by the tax authorities in the Dutch Caribbean. But today, tax authorities expect an arm's length markup for the service provided. However, not all services are low risk. When we move into management activities, strategic oversight, decision-making, assumption of risk, the analysis becomes more complex. In those cases, a higher markup may be appropriate depending on the functional analysis. So the key question is, what functions are performed, what risks are assumed, and what assets are used? The answer to those questions determines the appropriate return. So applying a flat 5% markup may be simple, but it is not always technically correct. Next slide. Now, let's distinguish this from a slightly different situation. These are the external services performed by independent third parties. If a group company pays a third-party supplier, for example, an external IT provider, legal advisor, or consultant, that service is already priced on an arm's length basis. So in principle, when that exact cost is recharged within the group, a 0% markup can apply. Why? Because the arm's length margin is already in the third-party invoice. However, this only applies to where the recharging entity is acting as a pass-through company, meaning it does not add value, does not assume additional risk, and does not perform additional services. If the entity adds coordination, oversight, or management functions, then the situation changes, and a markup may be appropriate. In practice, related parties may structure this through a joint account or cost-sharing arrangement. In that case, the group agrees upfront on how external costs are allocated, for example, based on usage, turnover, or another key. The important point is that the allocation must reflect the benefit received and the arrangement must be properly documented. Next slide. So far, we have mainly discussed transfer pricing from a profit tax perspective, but in the Dutch Caribbean, indirect taxes are equally important and sometimes even more immediately visible in tax audits. Each jurisdiction applies its own form of turnover tax, sales tax, or general expenditure tax. And the key point is that the intercompany charges are often included in the taxable basis. in principle. For example, in Sint Maarten, turnover tax applies at 5% rate, and related companies are regarded as separate taxable persons. That means intercompany charges such as rent or management fees can constitute taxable turnover. In Curaçao, we have a 6% sales tax. Where an intergroup supply is taxable, the intercompany price directly determines the taxable base. In the BEST islands, so Bonaire, Saba, and Statia, the general expenditure tax applies to goods and services. Again, the intercompany price may affect the value base on which these indirect taxes are calculated. And in Aruba, turnover tax is 7% unless a fiscal unity applies. Without a fiscal unity, intercompany charges are taxable turnover. What this means in practice is that transfer pricing does not only affect where profit is taxed, it also directly impacts indirect tax exposure. So if a management fee increases due to higher markup, the indirect tax base increases as well. So one adjustment can create a double effect, higher profit allocation and higher turnover tax. Next slide. So in principle, cost-sharing arrangements between related parties are treated as the provision of services and therefore can fall within the scope of indirect taxes. However, there are important exemptions. The first one is the so-called joint account cost-sharing arrangement. The second one are specific exemptions apply in the tax legislations. The third one is, for example, in Curaçao, where the place of business for sales tax purposes is located outside Curaçao, then you don't need to pay sales tax in Curaçao. Or in Aruba, where the parties form part of a fiscal unity, meaning intergroup transactions may be disregarded for turnover tax purposes. So when reviewing transfer pricing in the Dutch Caribbean, we must always seek three questions. First, is the pricing arm's length? That's for profit tax. Second, what is the indirect tax consequences of that pricing? And what can we do to minimize the tax exposure within the boundaries of the legislations and regulations? Next slide. So the first exemption was the cost for joint account, where a 0% markup applies, meaning there's no service element and no value added. Related parties may structure the recharge through a joint account arrangement, but this is not automatic. For the arrangement to qualify as a cost-sharing structure, several conditions must be met. First, the cost must be incurred for the joint account of the participants, meaning they are shared from the outset. Second, there must be a pre-agreed and objective allocation key. This cannot be decided afterwards or adjusted opportunistically. Third, only actual costs may be recharged. No profit element, no hidden markup. Fourth, the cost must be directly attributable to the joint purpose. And fifth, the economic risk associated with those costs must be allocated to each participant according to the agreed allocation key. And finally, the arrangement must be formalized and properly documented in writing. If these conditions are not satisfied, the arrangement will not qualify as a joint account. In that case, the recharge is likely to be treated as taxable supply of services and therefore subject to indirect taxes. So once a profit markup is applied, this structure can no longer qualify as cost sharing. At that point, you are dealing with a service transaction and indirect taxes will generally apply. In practice, we often see arrangement labeled as cost sharing that do not meet these conditions, and the label itself is not decisive. The substance of the arrangement is. Next slide, please. The second one are the exemptions. So while we have discussed how intercompany charges can trigger indirect taxes, it is important to know that this is not always the case. Indirect taxes applies unless a specific exemption or place of supply rules removes this transaction from the taxable scope. For example, certain services are exempt under the relevant tax legislation. In most of the islands, services such as life insurance, health insurance, or reinsurance are exempted from indirect taxes. This means that even if the transaction is priced at arm's length, and even it is between related parties, no indirect taxes would apply, provided the exemption criteria are met. Curaçao provides another important exemption through its place of supply rules. In principle, an entrepreneur established in Curaçao must account for sales tax on services rendered. However, for certain services, if the services are performed outside Curaçao and effectively used and enjoyed outside Curaçao, the place of supply is deemed to be outside Curaçao. So in those cases, no Curaçao sales tax is due. These services include advisory and consulting services, legal and accounting, IT, telecommunication, advertising, marketing, etc., etc. So in cross-border group structures, the place of use analysis become extremely important. So from a transfer pricing perspective, this means that how we characterize and structure a service can influence not only the markup, but also the indirect tax outcome. I think this was the last slide for me.
Great. Thanks, Vivian. It's great to think about these things in a practical perspective. Transfer pricing is one thing. They're all interlinked, indirect tax, all these different things we need to think about. But it also shows us if we think about it and if we plan it, you know, there's a lot of opportunity. There's a lot of thinking to be done and lots of things that can be done to assist the taxpayer. So just kind of, we have our wrap up slide now. And what do you do next? If you're now thinking, oops, I have to think about transfer pricing, it hasn't been on my radar before. The first thing is to understand, do you have transactions, right? Do you have cross-border transactions, sales, services, goods, interest? These cost-sharing arrangement, is it a cost-sharing arrangement or is it a service under transfer pricing principles, right? Because if under transfer pricing principles is a service, you got to apply markup and then you're getting into all other issues. So, you know, identifying is task number one. You then need to get the right advice to design appropriate transfer pricing policies and plans. What do we need to do as a business to tackle this? How do we go about this cleverly and ensure that we have robust models in place? Of course, you then need to get your compliance under speed. You know, make sure that we're getting our local files up to speed, that we're figuring out any risks and trying to manage them. And like with anything else, you've got to then implement and monitor these policies you put in place. Transfer pricing is a core part of your daily business. You know, are we sending invoices for these services that we render? You know, what's the paperwork as well as the documentation? How are they doing it? Are we applying the policy that's in our transfer pricing file per the documentation or per the legal agreement? Or is it just something that's in our local file, right? It's implemented into the business and we need to monitor the implementation of that. Obviously, we need to keep an eye on what's happening domestically. There is a lot happening, Vivian, since we started chatting about transfer pricing in your region. I don't know, was it 8 years ago? Something like that. There's a lot has happened. We were waiting for it to happen. It's happening. It's here. where the legislation is here. There's stuff to be done. And that's why Vivian and I felt it important to have this webinar for anybody who wanted to understand a bit more about transfer pricing, so that you would have a platform to get that information. We will, of course, share the slides with everybody. We're available on email for any questions. But I wanted to thank Vivian and her team and everybody here who attended for joining us today. And I want to leave the final word to you, Vivian.
Thank you so much, everybody. And actually, as Cabrini mentioned, we would like to bring awareness about transfer pricing in the Dutch Caribbean. Thank you.
Thank you so much, everyone. Thank you, Vivian.
Do you have a question? Yes. It applies to the same jurisdiction as well, because, for example, as Cabrini mentioned, if you have a company with a lot of losses available for compensation on the one hand, and another company with high profit, you can shift the profit from that company with a high profit to the one with losses available for compensation. So it applies indeed within the same jurisdiction as well. I think that was the only question we have.
Maybe more questions by email. There might be a bit to think about there.
Yeah. Thank you.
Thank you. I'm signing off, Vivian. Thanks, everybody. Appreciate it.
Thank you.
Bye-bye.
Bye all. Thanks.